All right, everybody. I apologize for everybody listening in on the webcast. We're running a couple minutes behind, but we are getting after it as quickly as we can. And I'd like to introduce our next piece of content, I guess. We're content providers. Look at us. At the Planet MicroCap Showcase, Vancouver. I'm your host. Yeah, right. I'm your host, Robert Kraft. We're actually doing a Fireside Q&A with Hamed Shahbazi, CEO and Chairman of WELL Health Technologies. And we actually, this was a cool thing that we came up with because, one, obviously I wanted to have Hamed on here because I always enjoy our conversations, but we did a long form interview, I think like a year, two years ago, something like that, where we did it on our MicroCap graduation series, talking about WELL Health and how you've been able to take it from zero. I think it was like 2 to 3 years at that time, but now it's 5 years here to where it is today at over 750 million annual revenue, plus generating over 100 million in annual EBITDA. So I figured we'd do an update, ask some more questions. So let me on the
Pleasure
webcast,
to be with you.
Yes, of course. Thank you for being. For the webcast, we're gonna go do our forward-looking statement slide and then our investor overview that you can see while listening in. So to start off, just as a quick introduction, aside from everything that I just said there, Hamed has been a supporter of Planet MicroCap and S&M for a long time. I've had the privilege of watching many of Hamed's presentations when he previously was the CEO of TR Networks, a company that he successfully grew and sold to PayPal in 2016. 2018, Hamed founded WELL Health Technologies, and in only 5 years, like I said, it has grown from zero to over 750 million in annual revenue, plus generating over 100 million in annual EBITDA. And then for those who aren't familiar, WELL is a publicly listed digital health company in Canada. WELL's solutions enable more than 28,000 healthcare providers between the U.S. and Canada and power the largest owned and operated healthcare system in Canada, with more than 130 clinics supporting primary care, specialized care, and diagnostic services. In addition, the company has extensive operations in the U.S. targeting specialized markets. I proved that I can read very fast. Now to some questions. Hamed, thank you for being here.
It's great to see you and be with you. Congrats on the event.
Thank you very much. All right, so let's start this off with a quick update. How are things going at WELL Health?
They're going really well. I think at the 80,000 foot level, we tech enable healthcare providers, and the opportunity that I saw, close to 6 years ago when I started this company was healthcare providers really needed digitization and modernization. Their practices were, for some of them, you could be in their offices, 6 years ago, and you would have had the same experience as compared to 40 years ago or 30 years ago, and that was, confusing given the digital transformation that we've all experienced overall. And the view was, look, no industry is going to evade digitization. So when are we going to see the true sort of tailwinds that are going to drive that? That's why I started the company, and I felt as a tech guy, if you will, as a tech generalist that's being able to apply software, workflow, and digital optimization and disruption to fintech and other industries. That the healthcare marketplace was a great place to be. And fast forward. We went through a period of time, i.e. the pandemic with COVID, that healthcare providers actually needed software. Mm-hmm. And so, we went through a period where, because frankly, when we started and we were pushing our ideas on digital transformation, some people were interested and a lot of people weren't. It was like, change management was very challenging. I don't know how many doctors but it's hard to get their attention. Time is money. They don't have a return on equity business model. They have a return on time business model. So it's famously difficult to get their time. But then, of course, physical distancing became a thing. Forced telehealth became a thing. And so we went from 0.25% telehealth penetration in the country to a peak of 80% in April of 2020, which is, enormous. And so many clinics closed and very few clinics remained open, and doctors, being able to kind of come in and carry that hybrid business. And I'm very proud that WELL kept all its clinics open. And at that point in time, we really demonstrated that we can deliver for providers. What happened after that is there were a lot of providers that continued to be interested in digital transformation. And now I think we just had this kind of multi-year acceleration. And today I can tell you that, the one thing that we focus on day in and day out is how to help tech enable these providers and how to get them to use digital tools that amplify them, make them more efficient, improve their patient outcomes. And we do that in two ways. Actually, really one way, and that is our digital platform. But we apply the digital platform in two ways. One is a SaaS a la carte offering, which more than, probably getting now close to about a third of all providers in the country are using. And then the second way that we can give you access to our platform is if you no longer want to run your own clinic, you come and join one of ours, and then all our tools kind of wrap around you. So we're getting more and more confidence that is working. Doctors are now seeking us out, particularly too because they've been forced to run businesses, and now that they realize they're not forced to run a business, they would rather join. We particularly see this with millennials. They don't want to run businesses. They want to work next to other, professionals, and they want the flexibility of coming in and out of, practice. And that's really working well in terms of us creating a fully managed hosted environment for them. If WeWork had a good brand, I'd say the WeWork of healthcare, but we'll have to find another
strike
one.
that from the webcast. I'm just kidding. No, they seek you out. They want to talk to the tech guy, But my next question, and that actually everything you just said leads to my next question, having to do with some of the keys to executing on the strategy and some of the success that you've seen at WELL Health. Like we said, from zero to where you are today in 5 years. What would you say are some of the keys to that success?
I think discipline is a big one. We often say it, well, the three most important things are discipline, discipline, and discipline. Because, once you start to get a reputation as an acquirer, you get a lot of people approaching you with a lot of stuff. And it's easy to say, I like that, I want to do that deal because I can. But you have to really hold yourself back. You really have to, write down and really commit yourself to a framework, commit your team to a framework of what you're willing to do financially, but also understand that there are things that are intangible that impact that as well, like culture. Like, can we all get along? Can we have the right legal levers, in case things go awry? And so a lot has to kind of work together. And a lot of times you really want to do a deal, but you just can't. And you have to. And so I think that's been a big part of our success.
Quick follow-up to that. I mean, what are some of your criteria? Because clearly that's been growth through acquisition, right? So what's been some of your criteria when looking at a potential company to bring into the fold?
I think we're first of all, we do a lot of due diligence, and some people don't love that. We get a lot of people coming to we get a lot of people coming to us and saying this is a short process. We already have a buyer, and they try to create a lot of pressure for you to make a decision quickly, and you got to maintain your decision.
Trying to game you, basically trying to
exactly. But I think the biggest thing for us is being financially disciplined and just like there are going to be times when people are willing to pay more than you want to pay, and they will try to stretch you. And there's some very talented bankers out there that are gonna do everything they can to contort you and twist you. And so we very early on established a framework for clinics, which was sort of single-digit EBITDA multiples. We didn't want to go. We wanted to sort of be in the 4 to 6 times range. That's actually fallen since the market came off. So even though the our currency came off like everyone else's, what we were buying came off. So actually the arb between where we're trading and what we were able to buy has even gotten better. So we've been actually very encouraged by what's happened as of late in terms of the last couple of years. We've done smaller acquisitions. We found that the low end of the market, the bid just disappeared. Any other companies in our sector that were publicly traded, a lot of them lost their currency. Even private market players, were not able to consolidate clinics anymore. And then a lot of people found that consolidating clinics isn't easy. You buy them, now you got to integrate them, now you got to deal with all those doctors. We created a very focused, committed, passionate, and experienced team to make that all, make that all work. But as you know, we also consolidated a number of software companies. We have a whole platform, $60+ million in revenue, well exceeding Rule of 40 kind of metrics. Which we think will be a $100 million business on its own. And we were committed to buying those at single-digit EBITDA multiples too, with non-speculative synergies. So And most of them we did do that, and that's not easy to do. Kind of very much borrowing from, channeling Mark Leonard, the Constellations of the world, Steve Sadler, mentors, things of that nature.
Very good. So my next question dovetails along with this as well, because I think everybody in this room and probably listening online all recognizes that, we're in this tighter capital markets environment right now. You just kind of addressed your criteria, but has that criteria changed at all because of where we are from a macro perspective, where we are with capital markets? And then are you seeing any more or better opportunities now as a result of the market conditions?
Yeah, it's changed. It's gotten tighter. When money supply gets tighter, your execution has to get tighter. Everything has to get better. You have to do better deals. You have to integrate better. You have to, every year we go through a very painful cost optimization plan. And people are like, hey, Hamid, in our all hands, you just talked about how great things are. Why are we doing cost optimization? It's like, because we have to, we're in an environment where we have to do the very best to deliver the greatest amount of efficiency possible. Multiples contract. And so you have to, if you want to move your business, move the needle, you have to buy stuff that causes even a greater ARB and creates more accretion, less dilution. Everything has to get better, and it's challenging, but I think it does separate the wheat from the chaff. And it also puts a lot more emphasis on integration. Because, and we're pretty buttoned down on this. We have a day one plan, the first 10 days, first 30 days, 60, 90, first 100 days. And there's specific goals that are programmatic for us that absolutely have to happen. And if they don't happen, we really try to close the loop and try to find out what happened. Yeah,
absolutely. So my next question then for you today, I think we wanted to also talk about access to capital, right? Because that's dovetails everything that we were just referring to. So first of all, how has WELL funded its organic growth and acquisition strategy in this capital constrained environment? And then part two is, what words of wisdom can you provide some other small cap CEOs that might be in the room or listening in about accessing capital and funding their growth?
Yeah, so look, I think this is an exceptional environment where the tap ran dry. So in this environment, as I mentioned, I think you just gotta, your deal making has to be exceptional to attract the capital and to show how you're creating value. I mean, ultimately, at the end of the day, this whole notion where I'm going to go raise, I'm going to create a war chest to go out and do acquisitions, I don't think that works as well today. I think the whole painstakingly putting deals together, just-in-time financing, demonstrating the accretion, the dilution, the strategic effects. Some people ask me, are your deals strategically accretive or financially accretive? I say they have to be financially, they must be financially, strategically, and culturally accretive. You can't do deals that after you do them, you say, well, that was a great deal, and we got something out of it that we didn't have before in terms of territorial coverage, but boy, we hate those people. They have to add something to the mix, right? And so I think so we're seeing we're seeing access to capital still there. I just think the bar has gone up. We funded a lot of our growth through organic cash flow and debt. And we've worked hard to pay down our debt. We're I think in our last reported quarter, we were under 2.5 times leverage ratio. And so we've made pretty significant acquisitions lately, and we haven't been raising any money. And so I think we're appropriately levered right now. And I think that, to me, that's what debt is. It's a bridge to equity, or if you build a very sustainable business, you can continue to grow. I mean, everyone hates dilution, right? But if you can really demonstrate that you are to be trusted with that dilution, I think that's the brand that you have to be able to have as a management team. And people still hate dilution, but again, if you can create value with that, most investor presentations will not show you the slide. Ours does, by the way. Will not show you the slide of what is revenue per share per share, and EBITDA per share, and cash flow per share. They'll just show you the nice top line. They'll show you where the chart's going. Sometimes the chart's not even going in the right direction.
You're at a MicroCap conference, all right?
Yeah, cool it, right?
Stop showing off.
But that's where, if you're really creating value, you should be growing your revenue per share. and your earnings per share. And that's what we're trying to hold ourselves accountable to. But yeah, no, I think there's still a lot of capital out there waiting. I do think it's a bit of a waiting game until the markets get going. I fully agree with Dave, who's obviously a phenomenal investor, and we're very lucky to have him. But this is a great time for small caps, and there will be a time when people care. It's just a matter of time.
Sure. And for the webcast, he's referring to Dave Barr, who did his keynote presentation just before.
Yeah.
Okay. So my next question then, because I really want to get to some Q&A from the audience. I'm sure everybody's got a ton of questions here. So my next question for you, artificial intelligence has become a big topic of discussion these days. What is WELL Health doing in AI, and more broadly, how do you see AI being used in healthcare longer term?
Yeah, I mean, look, I think it's, fundamentally transformational for almost every sector. I can't think of a sector that's not going to be profoundly changed by AI. And so as a company that tech enables its healthcare providers, it's obviously going to be a big part of our world. And it is. So it's revolutionized our internal delivery of product development. But also what we found as a company that's growing, we have over 4,000 team members now, probably within a few months, probably by the close of the year, we'll be about 5,000 or closing in on 5,000. As you get bigger, it's just part of life. You're going to slow down a little bit in terms of your ability to innovate. So there's some exceptional companies that can break through that, but even them, even in Amazon, that still acts like a startup, they're challenged to pump out new products very quickly. So this is why we started an AI investment program with our ventures arm, WELL Ventures. So we're making minority investments in companies that we can then. We're not just a check. We are giving them access to a huge pool of healthcare providers, healthcare clinics, and healthcare IT infrastructure. And so we announced our AI investment program, and we've got well over 100 interested parties in the first 10 days, which was pretty remarkable. And we've made some investments, and we'll make more. But the main goal there is to activate product development capacity internally and externally. Get those engines going, start integrating products, and start delivering for providers. I mean, this all comes back to your mission and your vision, and you have to be, you can't. AI is really interesting. It's very cool, but is it really tangibly delivering for your party? And for us, for example, we rolled out a AI voice scribe. So this is pretty remarkable. If you know any healthcare providers and doctors, when they get into the room with you, a lot of times they're taking notes. They got their head buried in the laptop, or they're taking notes furiously because they have regulatory requirements to publish notes in a certain format, and that's how they get paid. And if someone wants to audit them, they look at their notes, and sometimes they spend more time on the notes than they do in the consultation with you. So we built a tool based on generative AI that, with both parties' consent, listens to the conversation and is then able to generate a summarized patient note in the format that's required by legally by the healthcare authorities. Our providers love it. I mean, that's just one product that we've deployed that's done very well. We think we think the whole practice of medicine will change to being mostly voice activated by doctors in the future. So all that's going to be driven through AI. It's going to be quite interesting.
I was going to say, not to speak anecdotally and personally, my wife's a nurse. I mean, part of the reason it takes her so long to come home is charting.
Yeah.
So I definitely appreciate that. So next question for you today, before we get to the Q&A, WELL clearly has an established brand in the Canadian investor community. I think everyone in here knows WELL to one degree or another, and also listening in. But some of our audience may not be aware that WELL actually generates revenue in the U.S. too. So can you talk a little bit about your U.S. operations and what markets you serve in the U.S.?
Yeah, absolutely. Yeah, so most of our revenue and the majority of our revenue and our profitability comes from the U.S. Not to say Canada, we generate tens of millions of dollars of EBITDA in Canada, but in the U.S., the only big difference between the U.S. and Canada is that in the U.S., we don't sell the tech on an a la carte basis. as a provider, if you want to benefit from WELL's tools and technology, you have to join one of our fully managed virtual or physical clinics. And instead of trying to create a connected ecosystem like here in Canada, where we want the gamut of primary and secondary care across the country, that's our goal, is to create a connected healthcare ecosystem that covers most of the bases. In the US, that's already been done many times over. So we then want to go into specific areas where we think we can add value. So we're very strong in women's health. We're in all 50 states. We have probably the number one women's health business, telemedicine business that's focused on sexual and reproductive health. No one bigger than us as that pure play. That's one area. Another area for us is behavioral health. Our Circle Medical business, it's a primary care, hybrid telemedicine and physical clinic offering, but it excels in behavioral health. Depression, anxiety, ADHD, stuff like that. We are very big in, basically providing anesthesiology services to routine colonoscopies. So we have over 1,000 providers that are just involved in that service. So we serve the GI space quite significantly. So we have a mixture of primary and specialized care, just like here in Canada. But we just don't sell the tech. You have to join us to get, and that's the other thing too. Like what people don't realize about healthcare is that it's a two-sided market. Patients demand and physicians supply. And in most of the world, the demand is incessant. It's unyielding. It's always there. In some countries like Canada, it is even stronger because there's no friction to go to the doctor. Everyone wants to go to the doctor all the time. They get the sniffles, let's go to the doctor. In Scandinavian countries, you have to pay a small copay. People don't know that. And actually, I think it's very efficient. I would do it here in Canada, but I know no one would want it. But in any event, there's always this demand for healthcare services. So if you want to win, you have to secure the supply. So at the end of the day, healthcare becomes an exercise in accumulating a precious resource, which is healthcare providers. If you can secure the healthcare providers, you have a business. But that's not easy. And what we're trying to do is not just secure them, but value add them in a big way so that they never want to leave. I'll just say this. I love Amazon. I love great companies like that are a little bit controversial, that people love them or hate them, but everyone uses them. You talk to people, say, I've got my opinions about Jeff Bezos. Well, where do you do your e-commerce shopping? It's like, oh, Amazon, because it's fast, it's the best. And that's the thing. Like we want there to be absolutely no question that if you want the best support, if you want the best operating platform, the most tech-enabled operating platform that amplifies you as a doctor, that makes you more efficient, that you go to WELL, and that's something you got to work at every single day. I mean, Amazon has the best platform. They provide the best, the lowest prices. They're incredible, and that I think that's the vision that we have for the company. Just tirelessly delivering for our target audience.
Hey, your lips to God's ears, right? So my final question then for you here today, from what you can tell us, what would you say are some of the company's value catalysts or future catalysts that investors should look for from WELL in, let's say, for the rest of 2023 going into 2024?
Well, I think we have a lot of unlocked value at WELL. So some of the analysts look at us as a sum of parts play. Some of them just give us a multiple of EBITDA. But then you got huge growers like Circle Medical. That's $100 million plus business. Profitable, growing, and doesn't drive a lot of EBITDA. But we're basically getting very little, value on that because of its contribution to EBITDA right now. If that was a standalone business, what would it get? Well, Circle Medical is probably of the size of what Sun Life just bought. Dialogue, right? So roughly the same size of business, right? So that was just taken out for what, $300 million, right? So I think there's going to be opportunities for us to surface value, and that could be through potentially even spin outs. Like we just made this investment in in MCI One Health, where I'm not sure how many people saw that investment if you follow us. Okay, so I don't know if you noticed this, but MCI One Health, before us making this investment, they were in two businesses. They owned healthcare clinics, and then they had a data business. The data science business, it actually is an AI-enabled business that scans data, looking for rare diseases and chronic diseases, right? And they were trying to generate the data with their clinics, and they were trying to unlock the value of that data with their data science business. But they hadn't got to scale with each business, so they were kind of hamstrung. We bought the clinics and now invested in the remaining company, but we have an option also to acquire all of the founder's stock, 30 plus million shares. That's locked down. So we are now in a path to control of that business. So what that tells you, at some point in time, that's going to be a well-controlled public company. And when you look at the capital efficiency with which we did that deal, and you look at what our plans are with a data science-focused business that's looking to unlock the power of data, that's an entirely new lever. Well, we generate enormous amounts of data. We have 22 plus million unique patient profiles in this country, and we have zero attributed to data in our business plan. So that's just one lever, right? And forget the fact that our organic growth has been consistently double digit and very strong. So I think, look, I think at our last conference call we said we're a couple of years away from breaking through $1 billion in revenue. It's sooner. I'll just say that.
I wish we had a little more time for some Q&A, but that's a good place to end it, I think. So, with that, Hamid, where can our audience go and find more information on WELL Health? Where can our audience go and find more information on WELL Health?
On Pardeep. There's the man.
What the website?
The guy who looks like the proud father in the back.
WELL.company. All right. And for full disclosure on the webcast, I am not a shareholder in the company, but we do appreciate Hamid taking the time here and to share his insights.
Thank you.
And thank you. Thank you all.
Thank you.